So far, you covered the Poisson credibility model for a general distribution of the random risk variable. Essentially, we only proposed two requirements for the distribution of theta I: that its distribution should be positive and have unit mean. Now, to be able to run some actual calculations, you will have to specify a distribution for this random risk variable. Here, you will use a gamma distributed random variable. As such, the distribution of theta has positive support. To make sure it also has unit mean, we choose both parameters in the gamma distribution equal. This makes sure that the distribution has unit mean. Because the gamma distribution for theta is a so-called conjugate distribution for the Poisson distributed claim count random variable, calculations in this Poisson gamma setting are closed form and straightforward. For example, the joint probability mass function of theta I and the random variables ni1 until niti is printed on the sheet. The complete derivation of this expression is in the extra notes in your lecture material. You should verify this expression and make sure you understand all steps. With the gamma distribution being conjugate for the Poisson likelihood, we see that the posterior distribution of theta, given the observed claim history, is again a gamma distribution. Initially, the gamma prior distribution for theta was using parameters A. The corresponding posterior distribution of theta is again gamma distributed, but now takes parameters A plus the sum of all claims reported in the past and A plus the sum of the prior premiums lambda it. The latter are the a priori premiums for the risks ni1 until niti. The detailed derivation of this result is again documented in the extra notes available in the lecture material and should be studied. Now, having an explicit expression for this posterior distribution of theta I available, we can now show some actual credibility premiums. In the Poisson gamma model, the posterior mean of theta I, given the past claims ni1t till niti, is the ratio between A plus the sum of the nits and A plus the sum of the lambda its. This follows from the expression for the mean in a gamma distribution. Using the expression for the variance in a gamma distribution, the expression for the posterior variance of theta I, given the random variables ni1 until niti, follows easily. The base credibility premium then is obtained as the a priori premium, lambda iti plus 1, multiplied with the posterior expectation of theta I. This posterior expectation is the a posteriori correction that comes on top of the a priori premium. In the Poisson gamma model, the posterior mean of theta I, given the past claims ni1 till niti, is the ratio between A plus the sum of the nits and A plus the sum of the lambda its. If this ratio is above 1, the policyholder will get a penalty. If it is below 1, the policyholder will get a discount. Having an explicit expression for the a posteriori corrections available, we are now capable to add some reflections. Let us first consider two policyholders, say I1 and I2, who are followed during the same number of time periods in such a way that lambda I1, the a priori premium for policyholder I1, is smaller than lambda I2. So we make sure we follow them during the same number of time periods and in such a way that the lambda I1 bullet, so the sum of the a priori premiums paid for driver I1, is smaller than lambda I2 bullet, the sum of the a priori premiums paid for driver I2. Now this implies that a priori driver I1 is the better risk. Now, if both policyholders do not report any claim, the correction applied to driver 1 will be larger than the correction applied to driver 2. Thus, the a priori worse driver will receive a bigger discount in this specific case, where 0 claims are reported by the driver. Now, if the policyholders report K claims with K larger than or equal to 1, the penalty applied to driver I1 is larger than the penalty applied to driver I2. This actually means that driver I1 gets a bigger penalty than driver 2. He will be punished more severe for the K claims reported. So we demonstrated that in the Poisson Gamma model, the posterior distribution of the random risk variable theta, given the past claims, is again gamma distributed, with as the parameters A plus the sum of reported claims and A plus the sum of the a priori premiums. Recall that A is the parameter used in the prior distribution for the random risk variable. That is, we assume theta to follow a gamma distribution with both parameters equal to A. Using similar derivations, we can focus on the predictive distribution of the number of claims in the next time period ti plus 1, the predictive distribution of this random variable given the past claims. So instead of working with the posterior distribution of theta given the past claims, we now want to work directly with the predictive distribution of the number of claims in the next time period. Following the derivations in the extra notes, you will see that this predictive distribution is a negative binomial distribution. Using this explicit result for the predictive distribution, you now have yet another path available to derive your credibility premium. You can work with the negative binomial distribution and take the expected value of this distribution. Naturally, this leads to the same expression for the credibility premium as derived earlier on in this course. And once again, you see the credibility or posterior premium as the prior premium for policyholder I in period ti plus 1 multiplied with the ratio of A plus the sum of the number of claims reported and A plus the sum of the prior premiums. So if a policyholder reports more claims than expected a priori, the credibility factor will be above 1 and a premium increase results. If the policyholder reports less claims than expected according to the a priori pricing model, the factor is below 1 and the policyholder gets a discount. We'll now manipulate the expression for the Bayesian credibility premium. And the reason or motivation to work with this expression goes back to our initial discussion of credibility theory. In the first video on credibility, we motivated the credibility premium as a weighted average of the overall mean and the policyholder or contract specific mean. The weight used was the so-called credibility factor. And that's exactly the kind of reasoning we try to find here. Rewriting this expression for the credibility premium, we retrieve the a priori premium, that is the expected value of NITI plus 1, multiplied with an appropriate correction factor. And this factor is a weighted average of the prior expectation of the random risk variable theta and the average claim frequency reported by contract I. The latter is the ratio between Ki of Ki bullet and lambda I bullet. So, as a final step, we'll now work through some concrete examples of the Poisson Gamma credibility model, as demonstrated in the book by Denuy and co-authors. For a given portfolio following contracts observed during one specific year, the authors model the number of claims observed with a negative binomial distribution. Risk classification is incorporated in this model by setting up a linear predictor for the log transformed mean of this negative binomial distribution. Recall from the course on risk modeling and insurance and the section on frequency modeling that a negative binomial distribution is a Poisson distribution that is mixed with a gamma distributed random effect. Let this gamma distribution be specified as gamma with parameters A and A, with positive support and unit mean. Calibrating this density to the data, we find a suitable estimate for the parameter A on the one hand, and for the a priori premiums lambda IT in a particular period t and for a particular insured risk I on the other hand. The tables on the next sheets will focus on different scenarios, combining three ingredients: the a priori premium lambda IT of the driver considered, the number of periods ti during which the driver is observed, and ki bullet, the sum of claims observed during this historical period. The goal of this scenario analysis is to observe how the Poisson Gamma credibility model implements penalties or discounts based on past claim history for different types of a priori risks. In the first scenario analysis, we consider a good driver. This is a driver whose a priori premium is low compared to the a priori premium of other risk profiles in the portfolio. In this particular example, the good driver is a man, aged 35, living in a rural area, paying the premium once a year, using the car for private purposes. In the a priori premium model that was constructed for this portfolio, using the negative binomial regression model, his prior premium or his prior mean is 9%. The table then displays several scenarios for this particular insured risk. In the rows, we show the number of time periods during which the risk is observed. The columns list the number of claims reported during this observation period. For example, if the risk reports 0 claims, a premium discount will be awarded. That means the credibility factor applied to the a priori premium will be less than 1. The discount becomes larger when this excellent claim history holds over a longer time period. If the good driver does not report any accident during the first year, we see from the table that he will pay 92% of the base premium to be covered during the second year. If in addition, he does not file any claim during the second year, the premium decreases to 85.2% of the base premium. After 10 claim-free years, he will have to pay 53.4% of the base premium to be covered under this insurance contract. Now, considering the penalty in case one claim is reported, we see that the good driver who reports one claim during the first year will have to pay 178% of the base premium to be covered by the insurance company during the second year. That's obviously a rather severe penalty, which is difficult to impose in reality. We continue with the profile of an average risk. That is, for this particular portfolio, a woman, aged 25, living in an urban area, paying the premium upfront and using the car for private purposes. She has an a priori claim frequency of 14%. Considering this average driver, we see from the table that she will be awarded more discount than the good driver if she does not file any claim. Indeed, she will have to pay 88.3% instead of the 92% from the good driver of the base premium after one claim-free year, 79.1% of the base premium after 2 claim years, and so on. Now, considering the penalty in case a claim is reported, we see that the average driver who reports one claim during the first year will have to pay 171% of the base premium. As a final illustration, we consider the bad driver profile. A man, aged 22, living in a rural area, splitting the premium into multiple installments and using the car for private purposes. His prior claim frequency is 28%. Considering the average driver, we see from the table 3.3 that she will be awarded more discount than the good driver if she does not file any claim. And some conclusions become apparent after working through these scenarios. The discounts awarded to policyholders who do not report any accident to the insurance company are increasing with the a priori annual expected claim frequency. The more claims are expected by the insurance company on the basis of observable characteristics, the higher the discount in case no claims are reported. Note that the a posteriori expected claim frequencies remain large for a priori bad drivers, since reporting no claims happens with a very small probability. The penalties in the case where an accident is reported to the company are decreasing with the a priori annual expected claim frequencies, and the system appears rather severe. Reporting a claim entails a penalty of between 50 and 75%, which seems difficult to implement in practice. This is a consequence of the financial balance property. The weighted averages of all figures in each infinite row is equal to 100%. The modest discounts awarded to the majority of claim-free policyholders have then to be exactly compensated by the penalties supported by the minority of policyholders reporting claims to the company. And this causes large penalties. The severity of the credibility corrections also appears in the number of claim-free years needed to erase the penalty induced by an accident. 10 years for the good driver, 7 for the average driver, and 3 for the bad driver. These periods make sense compared to the average claim number per policy. This example concludes our discussion of the Poisson Gamma credibility model for experience rating.